Hello, everyone. Ladislas Maurice from the wanderinginvestor.com. So today I'm really excited about this interview. I'm with Josh Young of Bison Interests. He is known as an oil expert. Josh, can you give us a bit of background on you and what you do?
Sure. Yeah. So I've been investing in the publicly traded oil and gas space for professionally for the last 15 years or so. And with Bison, we invest in companies that are in the public markets that typically are oil and gas producers with good assets, good management teams, and survivable, strong balance sheets. And so I try to focus on those sorts of companies along with finding reasons why they're undervalued and catalysts, and try to understand the macro behind those companies. And by doing this for long enough, we end up finding kind of interesting things happening in the overall oil markets that we have some data on from the specific companies that we're following and analyzing.
Cool. So we're seeing gas going crazy all over the world. We're seeing coal going insane. Oil is starting to tick up, and people have been saying oil is next. But the bears say that this will not happen in oil because there's a lot of spare capacity in OPEC plus. So the two main culprits of this are Saudi Arabia and Russia. So can you talk about your view of Saudi Arabia's spare capacity?
Sure. Yeah. And this is regarding a Bison white paper that we put out. And what we do, like I was saying in the intro, is as we find really interesting things happening in the oil markets or the natural gas markets, if it's something that's really different from what people are saying or what people understand, and or if it's really driving a specific investment or set of investments that we're making, sometimes we'll research it a little bit further and then publish our research in the form of a white paper or other sort of analysis. And so we published this white paper recently on OPEC plus spare capacity and how some of these companies are producing less and have less capacity than they say. And so with Saudi in particular, it's actually like a really simple analysis. So there's like Twilight in the Desert behind me, which was the very kind of complex geologic driven, production analysis driven, based on engineering and all kinds of complex stuff. The very simple thing with Saudi Arabia is that anytime they've produced anywhere close to 10 million barrels a day, they've drawn their inventories down a lot. And so there's a polite way to say that, which is just that it looks likely that what they call production is a combination of production and sales of already produced oil. And so observing that, along with observing what their maximum production rates have been over the last many years, gives us a relatively easy to calculate number, which is well below what they state.
And if we take a step back, it's not that surprising looking at Aramco. They IPO'd, they really wanted to hit that 2 trillion mark, so that they were kind of cutting back on capex for a few years. And at the same time, the government wanted to shift away from oil, going into a newer Saudi Arabia based on technology, et cetera, et cetera. The fact that they may have invested less than they should have on maintaining production capacity is potentially not that surprising. So tell me about Russia, because the thesis is Russia has always been dependent on oil and gas. They are not too much into the whole green transition thing. Why would they find themselves in a situation where they don't actually have the spare capacity that they've been claiming they have?
Yeah. So one last thing on Saudi before going into Russia. You mentioned Aramco and their IPO. Aramco also did an infrastructure sale somewhat recently, and a brilliant investor who I worked for a little while, a number of years ago, he used to say that anytime I came up with something I thought was this like great investment to go show him, his response was, "Why am I so lucky?" And it's a dangerous response because sometimes things are just cheap and you're just that lucky. And there were a couple of things we didn't do that we really should have done that were incredible. But that sort of question, like any sort of heuristic, can also help you a lot in terms of staying out of trouble. And so if you think about it from a world perspective, like, why are we so lucky that we get to invest in the equity in the world's largest, supposedly largest oil reserves and the world's largest oil fields? at a price that was only at a moderate premium in valuation to companies like Exxon and Shell and BP that are like rapidly burning down the furniture in order to fund money losing alternative investments and having all kinds of other issues. So like, if you want a big oil company, like, why are we so lucky? And if you look at the history of it, these are fields that were nationalized when they had a lot of kind of runway and a lot of reserves remaining to produce. And it looks like this is just kind of a natural progression of things, whereas there's future disappointments likely, maybe similar to like what you see with SPACs or other sorts of dynamics. With that sort of thing, you may actually expect that when a illogical seller of something sells it for a price that doesn't really make a lot of sense at a time that doesn't really make a lot of sense, that maybe there's a reason they're selling it other than it being this like true gem that's super high quality that doesn't have any issues. So just as that like really high level heuristic, like, why are we so lucky? Well, maybe they don't have what they say they have. And then I got pushback from this person who's a supposedly big oil expert who is a consultant for them, among other places, saying, oh, well, you know, their reserve auditors are amazing. And they just used one of the big 3 US reserve auditors. And then I was like, yeah, actually not really. And they audit a bunch of US public companies along with others. And the pushback there was, oh, well, your portfolio at Bison can't afford these auditors. And it's like, what are you talking about? They audit like a third of Bison's portfolio. And it doesn't help me or hurt me to say that like their reports are not perfect. It's similar to like relying on credit rating agencies or other sorts of paid reports or like sell side research, right? Like it is, if you're not paying for it, you're the target. You're not the customer. You're what's being bought. So or paid for. So I think that's kind of an issue there. In terms of Russia, I think it's kind of a similar thing. Like you know, there are publicly traded Russian oil companies, but mostly those are held by like Russians and by investment funds that are domestic there. So that's not really that big of a, it's not the same sort of story of divestment for Aramco. Russia's I guess, simpler thing. It's just they overinvested and really aggressively produced their conventional fields in their transition in the late stages of them, I guess, being Soviet Russia, and then into the early 90s, they way overproduced and way underinvested. And so between the two of those things, they really damaged a lot of the reservoirs. They brought in new technology and ramped production back up. But when you look at like the productive capacity of some of these very large fields, they can get damaged heavily if they're misengineered or not kind of not well managed. And you see this with Mexico, where Cantarell and some of the other giant fields there have come into steep decline. You see it in Venezuela, where production collapsed. And so, you know, Russia's fields are better managed now than they were, but they're still suffering from this trauma of decades of mismanagement. And then new fields that are being brought on have issues. And there's another thing that we see that I don't think we really talked about in our white paper, but it's something that I've commented a lot in various articles and on Twitter and so on. As you see more issues with something, like when there's an operational issue, when there's a fire, when there's an explosion, whatever, like the individual cause of that thing might be really easily explainable or difficult to explain. But in aggregate, when you see those sorts of issues happening, they're indicators of underinvestment or indicators of fields getting towards the end of kind of their sustainable, slow decline, productive life. And so seeing this giant explosion at this Russian condensate processing facility earlier this summer, seeing other issues along those lines in Russia kind of repeatedly, similar to like kind of Suncor in Canada, where they keep having issues. They keep having fires and plant explosions. And there's like this whole running joke, which is, you know, kind of tragic and maybe poor taste, of people getting killed repeatedly by Suncor. And obviously not directly, but the implication is that. And it just tells you that like there's not as much there, that oil sands mine and so on, the ones that they're operating are kind of getting towards the end of their life, and they're having to engage in kind of bigger and riskier things, and or that they're just not maintaining their stuff as well. So I guess that's kind of a long answer. The short of it is like when you see a bunch of those incidents and you see production bumping up on a limit where historically they haven't cared what the OPEC limit's been. As you see production bumping up on that limit, along with incidents, the two of those things kind of tell you, hey, like they might not really be able to produce much more. And if they're saying they can produce 2 million barrels a day more, they show no evidence of it and they have all these issues. Hey, maybe like they're at their limit or pretty close to it.
Okay, interesting. So what about shale? Won't US shale come to the rescue?
Um, so shale's on strike, kind of. There's been this giant shale was like obviously like amazing technology and has really helped for a while in terms of US energy independence. And it helped a lot in terms of having a very high energy return on investment. So like most supposed innovations in energy in the last decade or two have had low returns on energy investment. So various improvements in solar panels or wind turbines or whatever, like a bunch of this stuff. These things just don't help that much. And they take a lot of, like, I saw this thing on solar, I guess it was like silicon in China, where coal prices had gone vertical. And so silicon prices went vertical. So like you're just shifting pollution over. For shale, it's different because it's very productive and there are large reservoirs, some of which have been tapped. The easiest stuff is almost all gone. So there's kind of this combination of things. There's core degradation, which is the best areas have mostly been drilled. And that matters because the step down from core to tier one in productivity is huge. And it's even bigger on an economic perspective than it is on a productivity perspective. So if you have a well that produces 50% of all the hydrocarbons it's going to produce in the first 18 months, it really matters if you get enough oil out of that to pay yourself back, or if you only get enough oil out of it to pay yourself 60% back or something like that. If you get all your money back, you can cycle that money over and over and over again and have a wedge of production that's either flat or that grows. But if you aren't getting your money back in 18 months or 24 months, really at the latest, then you really require substantial new capital just to sustain production. And so that's been going on for a while. And well productivity, especially on the oil side, flatlined several years ago. And so the story had been the technology was getting better and better and better. And so you wanted to invest in these things because their wells were getting more and more productive and they were dropping the cost of production. Well, now kind of the opposite's happening. And after hitting a plateau for a while, it seems more likely that well productivity is going to degrade than improve on the oil side. Then you get into available equipment, available people, the status of that equipment, the status of those people in terms of training and experience and so on. And then wage inflation and product inflation and steel inflation. And you're kind of hitting this point. We're pretty close to this inflection. We may already be in it and just not like really appreciating it, but shale wells may be getting much more expensive and much less productive simultaneously. And so we're seeing some indicators of that, but I don't think it's really like you could get more production out of shale, but it would take a lot of capital and maybe a radically different price and capital environment to accomplish that.
So what price would shale start to make sense?
Well, it makes sense now, and it makes sense at lower prices, and it makes sense at higher prices. I think you mean at what point does it make sense to start growing production from shale materially? And I think if you look back, shale production growth that was accomplished over the last like 7 years, like net, it was massively money losing. Institutions lost hundreds of billions of dollars misallocating their endowment and pension and whatever capital to private equity, and then hundreds of billions on the debt and equity side as well, invested directly into these companies. And you would have needed maybe like $70 to $80 oil just for that to have like not been massively money losing. And there's like fun with numbers where, private companies will sell the public companies to get an uplift, and then the public companies write down the assets. And so, in some cases, some of the private equity funds have won. In other cases, they were zeros. And, in aggregate, it's been a pretty disappointing place. So yeah, I think you would have needed $70 to $80 oil, but that was at a time frame where costs were comparatively low, and at least relative to where they may be in a year or two, and where well productivity was high and growing. And so in an environment where well productivity is maybe not as high and could be getting worse, maybe you need substantially higher oil prices, and then there's kind of this inflationary factor. So I don't know. You might need oil 2 or 3 times higher than it is right now to really get substantial production growth. And then there's like
PTSD. 2-3 times higher?
Yeah, but there's also like PTSD for investors, right? So like you might need it higher before, even if it was economic and even if it was accomplishable, right? Even if you could do it, you might not be allowed to do it by your investors. So like Scott Sheffield from Pioneer came out recently. It was like, yeah, we could grow. We're not going to. Here's why. And I don't know that he could grow. And he's made very aggressive statements before like that he's had to walk back, usually quietly and years later. But I believe that they could grow just again at a higher price. Or without accomplishing basic capital return requirements and parameters that they've committed to. But yeah, I think you really need a much higher price, and then you're having this escalating problem of core depletion, and then you're not really seeing many new shale plays. It's not like the 2008 to 2016 timeframe where every year or two there was another big shale play that was really highly productive. The closest thing to that is in Canada, this like kind of Clearwater blue sky play, but that's maybe going to get a few 100,000 barrels a day at kind of peak production, maybe even 1 million if it's like really successful. But that would be like 10 years out and kind of a whole different story. There's not really anything to point to as the next big thing, and there's a lot of fields to point to as this field is depleted. Almost no one's drilling here anymore, and there's almost no incremental production to get from this field.
So things really point towards higher oil prices. So how are we going to plug the supply gap?
Higher prices. I mean, there's offshore, international, but capital keeps falling in those regions mostly. And so some of it's geopolitical risk and some of it's other issues. In many cases, discoveries that looked promising are underproducing in various world, like kind of non-OPEC, non-North America places. And so, yeah, I mean, I think you really need prices high enough for demand destruction. And the scary thing is, so I was just in LA a few weeks ago visiting family, and there were gas stations with $4 a gallon gas and gas stations with as high as $6 a gallon gas. And yeah, the $4 ones were a little busier, but the $6 ones weren't empty. People were still buying gas for $6. And so, I think gasoline maybe needs to be much higher. And in Europe and other places, it is much higher already. But there does seem to be some significant price or demand inelasticity. And so I think you could see demand pretty strong, even at much higher prices, which is terrifying because if you end up with a multi-million barrel a day production shortfall versus demand, you could need to see much higher prices before people really slow down consumption enough.
So for the generalists out there, how long does it take to take a field, for example, an offshore field in West Africa, from discovery to actual production, or in Alaska?
Yeah, so it really just depends on the particulars of the field and the place. So if it's in like a country that's never produced, whereas almost no offshore production, so like there have been various exploration attempts in Namibia. I've helped fund one many years ago. It was unsuccessful. Like if it was in Namibia, for example, just to pick on them for a second, and I have no investments there, at least none of the companies I'm invested in I'm aware of are active there. But if there was a discovery offshore there, it would probably take 8 to 10 years to go from first discovery to actual production. You'd probably be producing it through an FPSO. You need to keep the drill ship there.
And with existing producers like in Nigeria, Ghana, Ivory Coast?
Yeah, much faster. So you could get like 2 to 5 years from discovery to production, depending on kind of where you are. In the Gulf of Mexico, there's been a lot of hub and spoke stuff where you drill really close to existing platforms. And, 2 years is probably the fastest you could think of because you're building underwater pipe and you're doing all kinds of stuff. But if you're like 10 miles or 20 miles or something from an existing production thing, like that's not bad. And if there's capacity at it, if you're further, if you build more stuff, like 5-ish years. And then you said Alaska. I mean, maybe never. People keep asking about this 1 or 2 really like onshore, supposedly like resource or big exploration plays. And like, there's stuff that goes on. We see this with like Camber right now, which is this like pump and dump microcap garbage thing. There's kind of similar activity as you go up and down the spectrum of market cap and quality. And like, it's unfortunate, and it's starting to happen again in oil and gas, where especially with a space like oil and gas, where it's really big and where there's very few people left who have been focusing on doing this for a while, it's very easy to become the prey of a scammer or promoter or kind of whatever you call it. And so, a few of these things, I'd say in Alaska, are being promoted by people with varying degrees of credibility. And generally, there's just not an ability to actually bring the oil that they may have discovered onto the market. And so, depending on the place, like in West Africa, you can almost definitely produce the oil. It might be stolen from you, your stuff might get blown up, but like to the extent that you're able to navigate that, you probably can produce it. If you have a discovery in the North Slope, like you might not be able to produce it ever, and then they might just shut down that whole pipeline and not let you truck it, and so you might be stuck. And there's like big discoveries in like northern Alberta, and I always forget the name of the province just to the north of Alberta, but there are big discoveries up there that aren't getting developed as well. Similar sort of idea, right? Like there's resource there, and maybe it's worth something, maybe not, but like there's a lot of regulatory, it's essentially geopolitical risk. We don't really like to talk about that for America or Canada or whatever, but like there is real risk there. And so when you look at valuing something, if you might not ever be able to sell it in a success case, like I just don't know, I'm like not that good at figuring out how to value that. And my sense is that people that are speculating on these things aren't really understanding the level of risk associated with something that could just potentially never be produced. There's stories about, oh, it's near a road or near a pipe or whatever. And yeah, great. Like I can show you a bunch of other things that are near roads or pipes that just never, ever get produced. That doesn't necessarily matter. It matters like jurisdiction and regulations and trajectory. And the trajectory up until this energy crisis right now in Europe and Asia, the trajectory from a regulatory perspective has been substantially negative. And so unless there's a really big change, I would lean towards things being harder to produce in the future and less likely to come on rather than easier and more likely.
So actually most Western governments have been very much against fossil fuels. Big banks stop financing newer projects. Even the oil majors like BP, Shell are gradually moving away from oil. So is this part of a plan to increase prices to hasten the energy, the green transition, or is it just a policy mess up?
Can it be both?
It can.
Yeah, I mean, I think it's probably a little bit of both, right? I think there's definitely groups that are trying to encourage consumption of alternative energy, partly by raising prices and or reducing availability of conventional energy sources. And then there's also like, I think that's a goal from a policy perspective too. And then the ways that those things are implemented can have severe unintended consequences. And so one of the things I've done, and like, I guess it's worth sharing the context for this OPEC plus spare capacity report. Prior reports have included stuff on like northern Oklahoma, where there was an overbuild of pipeline capacity, and you could buy producer stocks that were discounted because the pipes used to be full, and so the local realized price used to be bad. And now that there is like much less activity, especially when we put out that report late last year, there was almost no drilling activity in northern Oklahoma. And so you could see that the pipes were pretty empty. You could see that the pricing for the local pricing was good. And you could see and hear that people were still valuing these things based on their historical earnings and cash flow, and were not properly crediting what was happening. And so you might sound like a stretch, like, hey, what does like northern Oklahoma or West Texas natural gas or NGL pricing have to do with OPEC plus spare capacity? And like, there's two answers, right? One is nothing, right? It's like the joke about what's his face's books, right? Yeah, the fancy books. What does this thing have to do with that thing? And it's like, what does sandcastles have to do with North Korean nuclear policy? And it's a joke cover, and on the title it shows not the title is nothing. So on the other hand, like, from that sort of methodology, like, I think if you just start with like, what do we see, and like, what can we prove right now? Like, what's happening, and like, how is it different from the story that's being told? And I think similar to this West Texas natural gas price differential having closed, but there being Bloomberg and other reports that like the price was zero, even though it was just both wrong or like a very temporary blip and not indicative. And unlikely to be the case in the future, or Northern Oklahoma or other stuff, or even the reporting around OPEC, where there's still mostly, I mean, you see more and more information coming out on OPEC and on kind of general production capacity from various countries. And then you see like the president of the United States or like this, the secretary of state, like embarrassing themselves, coming out and saying, hey, produce more oil for us. And it's like, well, maybe they can't. But like, also, who are you talking to? Like, who told you that it's a good idea to go publicly say that OPEC should produce more oil? Like, it's not going to win votes in many places where there's, manufacturing bases, because people understand that there's millions of jobs in the US associated with producing oil and gas. And it's also unlikely, if anything, it just might send oil prices higher because it like helps build the perceived scarcity. And I guess just the last thing on that, and that was a mouthful, but perceived scarcity matters a lot. And I think we're seeing it where like, I don't think this current bout of inflation is likely to be short. Inflation is almost always transitory in the sense that like in the end, they just like reset the currency and, engage in very dramatic policies in order to end it, but, or do what Volcker did and just like kill a lot of things in order to, from an economic perspective in order to end it. But it's very likely as we have these increased perceptions of scarcity for prices to go higher, because there's just this like circular effect where people being worried about their dollar paying for less, or worried about a grocery store shelf being empty, or hearing the president of the United States essentially giving up on energy security and saying, hey, we need more production from these unstable countries that we've been pulling our security support from and military support from. I mean, these are things that like lead to stockpiling, lead to devaluation, lead to inflationary behavior. And you kind of need people to believe that to some extent in order to really have big bouts of inflation. And we're seeing that right now, and like weirdly driven partly by misinformation about oil and gas. I don't know. I guess the last thought on that, it's like the Vietnam policy, right? Where they like fired everyone from the Kennedy administration. Johnson did because, just wanted like a new set of, he wanted, his people. And so they had no people that knew about Vietnam. And so they escalated, and when they should have just left or de-escalated or whatever. And I think it's kind of similar, right? Like you have this administration that's kind of fired everyone. And like many of the people that knew what was going on have retired, have moved on, have refocused. And so I don't know that there's really like that many credible sources to even point to, even when like the data is right there. You can just see, okay, well, Russia, in September, they produced a little bit more, but like for a number of months, and now actually for a while, they've really not produced anywhere close to what they're saying they can produce. And similar with Saudi, where like they have this headline number, and then anytime they produce anywhere close to that, their inventories fall a lot. And it's not my hand waving, like you actually see it. And they like, there's stuff from Jody and from other sort of like satellite type things. There's multiple different ways to triangulate to that. So, it's just wrong. Like they just don't have, they're not out yet, but like they definitely don't have nearly as much capacity as they say. And I think we're starting to see some of the knock-on effects from that.
Interesting. Yeah. And with higher energy prices, investors need to be ready for higher geopolitical volatility. We're going to have an interesting few years ahead. Great. Fantastic. Josh, thank you so much for your time today. I really appreciate it. I really recommend people subscribe to Josh's and Bison Interests free newsletter. You guys often come up with white papers and free research. Honestly, it's fascinating. It's a great resource. I'm always looking forward to that email coming from you guys. The link to Bison Interest is below.
Thank you very much. Thanks for having me on.
Cheers.